Welcome back to the bull versus the bear. Today, we're diving into a company that's right at the epicenter of the AI gold rush, CoreWeave. They're sitting on a $50 billion mountain of future business, but they're also carrying a mountain of debt. So, is this the next big thing in AI infrastructure, or is it just a spectacular flameout waiting to happen? We're going to break down both sides of this argument right now. So, to really get this debate, you got to understand where CoreWeave even came from. Back in 2017, this was not some AI powerhouse. Nope, it was a crypto mining rig literally sitting on a pool table. Fast forward to today, and it's a behemoth with a $55 billion backlog of business they've already locked in. That journey is just wild, and it's exactly what we're here to unpack. Is this incredible growth story the real deal, or is it all just a house of cards? All right, let's kick things off with the bull case, which you got to admit is pretty compelling. The argument is actually simple. We're in an AI gold rush, right? Well, CoreWeave isn't just selling the picks and shovels, they're selling the massive, heavy-duty machinery that absolutely everyone is desperate to get their hands on. And the demand? It's just off the charts. This number right here, this is the bedrock of the entire bull case, $55.6 billion. And let's be clear, that is not some hopeful projection. That's the company's revenue backlog. This is business that they have already signed contracts for. So for the bulls, this isn't just a number, it's practically a guarantee of a huge revenue stream for years to come. And that backlog, it isn't just big, it is absolutely exploding. We're talking 271% growth year over year. I mean, to put that into perspective for you, they added over $25 billion in new contracts in a single quarter. That's not just growth, that's hyper-acceleration, and it's all being driven by the biggest tech companies in the world fighting for a piece of the AI pie. So who's doing all this buying? Well, a massive chunk of that demand comes from deals like this one, a $14.2 billion contract with Meta. Just think about that for a second. Meta is building out its own massive AI infrastructure, and they are still paying CoreWeave billions of dollars. That is a massive vote of confidence from one of the heaviest hitters in the game. And I love this quote from the CEO, Michael Intrater, because it's so blunt. He just said, "They loved our infrastructure in earlier contracts and came back for more." This shows it isn't just about landing one big fish. It's about delivering a product so good that the biggest companies on the planet become repeat customers. It's proof that what they're offering is the real deal. So you're probably wondering, why are giants like Meta choosing CoreWeave over established players like Amazon or Microsoft? Well, it really boils down to this. CoreWeave is a specialist. While the big cloud guys are kind of jacks of all trades, CoreWeave's whole network is purpose-built for one thing and one thing only, massive AI workloads. And the result? They're claiming to be up to 35 times faster and 80% cheaper for these specific jobs. That is a massive competitive advantage. Okay, that all sounds pretty amazing, right? Well, for every bull, there's a bear. And the bear case here is, well, it's just as strong. The argument is that this incredible growth doesn't come for free. It's being paid for with a level of risk that makes this whole thing feel like a very dangerous high-wire act. Okay, here's the real heart of the bear argument. On the surface, things look great. A gross margin over 74%. That means just renting out their hardware is super profitable. But you gotta look deeper. The net margin is negative 28%, which means after paying for their insane expansion and everything else, they're still losing a ton of money. The bears say this kind of cash burn is a huge red flag. So how are they paying for all this? Well, with debt. A lot of debt. A debt-to-equity ratio of 7.5 is incredibly high. They are literally funding this race to build data centers with borrowed money, which creates massive financial risk. If their growth stalls for even a second, or if interest rates stay this high, that mountain of debt could absolutely crush them. And this chart? Oh, the bears love pointing to this. In just the last 3 months, company insiders have sold shares 93 times. And the number of times they've bought shares? 0. Zilch. Now look, insiders sell for a lot of reasons, but the complete lack of buying just raises one simple question. If the future is so bright, why aren't the people on the inside buying more stock? Then you've got the customer risk. Right now, around 70% of CoreWeave's revenue comes from just one company, Microsoft. Now, to be fair, that is down from 85%, and the big Meta deal is going to help diversify things. But for now, the company's fate is just overwhelmingly tied to the whims of a single client. That is a very, very risky place to be. And finally, the bears point to signs that this rapid expansion might be getting, well, a little messy. The company recently had to cut its revenue forecast because of a power delay at a new data center. At the same time, their massive $9 billion bid to acquire a competitor got rejected not once, but twice. These aren't just minor hiccups. They raise serious questions about whether the company can actually manage all this explosive growth. So there you have it. You've got the powerful bull case, and you've got the very serious bear case. The future of this company is going to be decided right where these two stories collide. So let's look at the key battlegrounds. Let's break down these core conflicts. First, the backlog. Bulls see $55 billion in guaranteed demand, but the bears fire back that a backlog is worthless if you can't build the data centers fast enough to actually service it. Then, the finances. Bulls believe this massive growth will eventually lead to huge profits. The bears see a mountain of debt that could lead to bankruptcy first. What about competition? Bulls trust their specialized performance advantage. Bears say giants like Amazon and Google can just throw unlimited money at the problem and catch up. And finally, valuation. Bulls argue the stock is a bargain for its growth. Bears say it's just a volatile gamble fueled by pure AI hype. And that brings it all back to you. You've heard the bull case for absolutely explosive growth, and you've heard the bear case for extreme high-wire risk. So now you have to make the call. The question really is this simple. Is CoreWeave the next Nvidia, an absolutely essential piece of the AI puzzle that's going to dominate for years? Or is it a massive FOMO trop, a super high-risk gamble that's going to burn investors who just got caught up in the hype? So which side are you on? We really want to know. Drop a comment below. Are you a bull or a bear on CoreWeave? And more importantly, tell us why. Your reasoning is what makes this whole community awesome. And hey, if you enjoyed this breakdown, do us a favor and hit that subscribe button for more deep dives from the bull versus the bear. Thanks for watching.